Hi everyone, thanks for joining us today for our second segment. We'll just give it a few minutes more for rest of the audience to join in. Okay, thanks for waiting. So hi everyone again. Welcome to the second segment in our series of alternative webinars. So thanks again for taking the time to join us during lunch, and to our Muslim friends, I hope your Ramadan has been fruitful and wishing you a very happy Eid Mubarak in advance. Warm welcome to our audience from Hong Kong as well. So for today's session, we'll be talking about private real estate, and I'm pleased to be joined by our friends from UBS Asset Management. We will first touch on the different types of real estate before having a quick comparison of public and private real estate. We will then discuss the different strategies or styles involved in real estate investing before moving on to how investors can gain exposure to real estate and why they should consider an allocation to this asset class. Finally, we will talk about some considerations of real estate investing before you start off your investing journey, and conclude with a Q&A session. So again, a gentle reminder that this session will be purely educational in nature. So we will not be talking about any specific products or answering any questions about specific product offerings as well. If you would like to find out more about our offerings, please contact Private Wealth at endowus.com. So on this slides, we have several important disclaimers to take note of. Yep. And as everyone would already be quite familiar with, we have a great deal of financial education and literacy content. So please feel free to visit our Insight page and YouTube channel if you're interested in other topics. And also, if you have any questions, please post them on Slido using the link here. Now, to kick things off, I would first like to introduce our two guest speakers from UBS Multi-Managers Real Estate team, Daniel and Gus. So both gentlemen have roles that are similar to the Endowus Investment Office actually, but primarily focusing on the real estate sector. So Daniel, why don't we start off with your introduction?
Thanks, Johan. So thanks for having us today. Quick intro of myself. I've been with UBS Asset Management for about 5 years now in the multi-managers real estate team. And prior to this, I spent 4.5 years at Credit Suisse in their equity research division focused on listed real estate, so REITs and developers. And prior to that, it's not written here, but I did spend a year on the equities trading desk on the investment bank side at UBS. So based on that trend, you can probably tell that I'm not a morning person, as I move more from a 6:30 a.m. kind of starting time to more like a 9 a.m. Start time.
Hi, everyone. My name is Augustus Set. Most people call me Gus, so I work in the same team as Dan here in Singapore. I've been at UBS for now 8 years. I joined as part of the grad program, so I was fortunate enough to get to see different parts of the bank before ending up in real estate in this team, which I've now been here probably close to 7 years. Yep. So maybe I'll just kick off already. Just a quick introduction about our team. So they call us the multi-managers real estate team. We're part of real estate private markets under UBS Asset Management. Currently, we manage just under about 27 billion US dollars in equity for our clients. We've got around 1,200 clients that invest with us, a few global fund of funds, and we also manage some separate accounts for some larger clients. We've got a long track record, about 15 years, and we've now built up a pretty global team that has good on-the-ground presence, located in some key markets that we invest in. So we currently have about 150 different investment positions. We have 60 staff in 9 locations in the US, Europe, and APAC. Our team in Singapore, there's 9 of us, so we look after all the APAC investing portions for our portfolios. Yeah, and there's just a little graph that illustrates where our 60 staff are located globally. So you'll see in the US, we have a presence in Chicago, San Francisco, and New York. In Europe, most of our investment team sits in London, and 9 of us, yeah, so all of us in APAC are based in the Singapore office.
Right, thank you both, and I'm excited to hear your insights on the topics we will be discussing. So before we jump right into the main content, we have to first ask, what is real estate investing? Well, for most of us fortunate enough to own an apartment in Singapore, we are already investors in real estate. So broadly speaking, investing in real estate can be split into 2 segments. The first is a primary residence, where you and your loved ones will be living in. So this property tends to be chosen with great care, as consideration is given to factors such as proximity to well-known schools, facilities, and services provided. So it tends to be also more lovingly furnished and decorated. The second segment would purely be, I guess, for financial returns, either from rental income, dividends, or capital appreciation. So Gus, for the second segment, am I only limited to buying another apartment, or are there any other types of real estate I can invest in?
It's a great question. So yeah, I mean, you have your primary residence. I guess other than that, you know, for an investment, you could buy, say, individual condo units or houses as an investment. But there's a lot of other sort of traditional commercial property types that you could invest in. So we've outlined some here on this slide. So you might have, you know, a full office building, for example, you know, a high rise in the CBD, central business districts, where, you know, you have tenants like banks, law firms, tech firms. There are industrial logistics buildings, for example, you know, an Amazon warehouse where they would store goods so that, you know, when you order your groceries or your clothes online, that's where the trucks would go to pick them up and deliver them to your doorstep. There's retail, you know, there's shopping malls. Obviously, there's different types, right? There's sort of, you know, high street or high-end fashion along Orchard Road, or your more suburban shopping mall that's in your neighborhood where people would go to buy groceries or for other services, whether it's tuition centers or doctors or GPs. And there's, I guess, residential or apartments for rent. So, you know, instead of buying, let's say, individual units, you might even just own the whole building and lease out all the units for rent rather than, you know, trying to sell them. So these are some traditional types. There's also other alternative sectors, things like data centers, healthcare type assets like hospitals, for example. Yeah, so on this slide, I mean, we're just trying to illustrate some of the different, I guess, subsectors. Even in these sectors, there's, you know, quite a bit of different types that you could get exposure to. So I guess in the blue highlight in the top portion of this table, some examples. So, you know, if you start from the left, if I look at office in the first column, there's CBD, the central business district, that type of office. But there's also other types that could be located away from the CBD, right? So you could have business parks or decentralized type locations that are more campus style, so the likes of Google or life science precincts in Singapore utilize that type of office space. In logistics, you know, there are some subsectors, let's say cold storage right there I have at the bottom, where you know, these are not just empty warehouses, but they might be especially equipped to handle the storage of certain types of products that require lower temps. So, for example, it could be certain types of medicines or frozen and fresh food that require a bit more colder temperatures, let's say. So just some key characteristics as well in the gray boxes at the bottom of this table, right? I guess some things to look out for as you invest into the different type of sectors. Some considerations could be the same, some might be a little bit different. So, if you look at office, obviously location is pretty important, right? You'd want to be in a developed market with a developed sort of CBD. Even in the CBD, right, the building that's right next to or right on top of the MRT or the train station could be more desirable than one that's, you need to walk 15 minutes to get to the office. In logistics, I have down there, location also important, but I wrote location and accessibility. I guess a little bit different from office, right? You don't actually have to have the warehouse located right in the CBD or in the central, but accessibility in terms of it might be good to be located close to, let's say, the exits or the entrances of highways that are well connected to different parts of catchments of people. Warehouses tend to be much larger buildings as well that require more land. So in any case, they're not really located in CBDs. They tend to be a little bit further out. In retail as well, right? When you think about location, it doesn't always have to be, super central in the CBD. It might be a bit further out location, but somewhere that might service a few different suburban populations, somewhere that has a very dense population and strong population growth. That would mean, continuing business for your retail asset that people would walk through and spend money in. So I put down there also competing supply, right? So it's important to take note that there might be competitor malls around your building that could take business away from you or have more attractive amenities. And tenant mix in retail is something to consider as well. Having just the right mix of different types of tenants to service the surrounding needs, right? So, for example, if you're in an area that had a lot of elderly or retirees, you might not want a whole bunch of tuition centers or childcares. Maybe you have some component of medical care, pharmacies, physiotherapy, some sort of X-ray or imaging type services in your building. In office, maybe tenant mix, you don't think about it that much, as long as you have good quality tenants, good credit quality tenants that can pay their rents, or also some good names that you could potentially attract other tenants. And in logistics, maybe that mix is sort of less important, right? You might even just have one tenant, whether it's an Amazon or a DHL, someone that's in charge of distributing the goods. So it's not really about people visiting a warehouse. So there's some differences between even the subsectors of the assets. So just a quick case study I have here. So what we have here, it's a mixed-use asset in the Singapore CBD. I guess mixed use, what I mean is there is some office component, there's some office space in there, but there's also some retail tenants in the building, which I think is quite common. The building close to an MRT, so it's a pretty good location, but it's sort of old, not very well managed. So the tenants inside, they're basically not paying that much rent. The building's a little bit older, a bit shabbier. And the retail mix, maybe it's a little bit strange, so it's not attractive for people to go out of their way to visit. So that means, maybe you have an opportunity to buy in at attractive price. What you can do is you spend some money to refurbish the asset, make it a little bit nicer, newer, shinier. And in doing that, you can attract higher paying tenants. So what you can do is you can slowly kick out some of the old tenants that aren't paying rent, and you can get some new tenants to pay higher rents. Improve the retail mix, make it a bit more attractive destination, whether it's a combination of gyms or some good F&B. And then after doing all that work, you could sell it after, let's say, 3 to 5 years or so, and it is a higher quality building at that time, and you get a pretty good return on your capital. So I think in this example, because you end up, vacating some tenants to do your refurbishment, to fix up some of the floors, your income return wouldn't be as high, right? You're not clipping a lot of rental income because you need time to fix up the space, and part of the building will be vacant for a while, but it's a little bit more of a capital return type strategy where you're buying an older asset, you're fixing it, and then you're selling it as a higher quality asset after that. So just one example of a strategy that you could do.
the next example is a hyperscale data center development opportunity in Australia. And so thematically, data centers are an attractive sector. It's seen continued strong tenant demand due to cloud growth and the rise of artificial intelligence. So things like Chat GPT is expected to further drive data usage for these sort of assets. One unique characteristic for data centers is that they are mission critical assets. So that essentially means that they run nonstop all year round. And so one example of why you don't want to end up with your data center unintentionally going offline is that back in 2017, there was a British Airways data center where a maintenance person accidentally switched off the power for 15 minutes. This took down their website and people were unable to check into their flights and resulted in 800 flight cancellations. 75,000 people were stranded, and this overall cost 140 million US dollars to British Airways. So 15 minutes resulted in pretty painful outcome for British Airways. And so examples like this kind of illustrate that there's been a lot of growth towards outsourcing data centers to specialist operators, and that really shows that it's very important to go with a high quality operator with a very strong track record. So going back to this example in Australia, this opportunity in particular is with one of the largest global operators that have a very strong track record, and in our view is a key consideration as to why this would have been an attractive opportunity.
Right, thanks, guys. And then, so of course, many Singaporeans are actually already familiar with real estate investments via the use of REITs. And this popularity has actually made S-REITs the largest REIT market in Asia, like Japan, with a total market cap of 100 billion Sing dollars, and also possibly the world's highest percentage of the stock market at more than 10%. So with such a well-developed industry right here at home, do investors still need to look elsewhere for real estate exposure? So here we have a comparison between S-REITs and private core real estate funds. As always, fees are very important, and we can see that there are quite a few fee components for S-REITs. These expenses can vary by REITs, and hence the total expense ratio can encompass quite a wide range. For private real estate funds, the fees typically consist of management and performance fees. In terms of the portfolios, a single REIT can sometimes consist from 5 to 30 or more properties, while a REIT ETF could have maybe 100 plus to 1,000 properties. On the other hand, private real estate funds typically have about 20 to around 300 properties, while a fund of private real estate funds can have properties numbering from hundreds to thousands. So in a way, this actually fits through to the minimum investment amounts for private real estate funds, as they tend to be higher at least 10,000, while an investment in REITs can start off as low as $100. REITs are also typically allowed to invest only in the equity of a property, while private real estate funds do have the flexibility to invest in real estate debt or credit. So Daniel, are there also any other important differences worth noting when comparing the two sub-asset classes?
Yeah, so I think first thing, it's worth elaborating on the minimum investment amount here. So typically what we see is that to invest into a core private real estate fund directly, the minimum amount is usually around 10 million US dollars. But as the space has evolved, as you can see here, the investment minimum amounts have now been lowered. So it is becoming more accessible to more people. So just moving down this table, I guess maybe just focusing more on the key ones. I think the next key one to point out is on the liquidity. So for listed REITs, as you probably know, it is pretty easy to enter and exit REITs basically immediately, subject to that bid-ask spread for a given stock. For core real estate funds, however, and Gus will talk more about how we define core later, but typically when you invest into a core private fund, you join the subscription queue and you are able to join on a quarterly basis. Typically it takes 2 to 3 quarters to have your capital drawn, and the ability to redeem and get your money back is also on a quarterly basis. But again, it can take, call it, 2, 3 quarters or more, depending on the fund. So that is one key major difference between REITs and core funds and core private funds. The other main difference, which I want to point out, is on the distribution yield. So typically, the yield that you get from S-REIT tends to be higher than for a private fund. And that's because Singapore REITs, the key focus for them is to maximize their distribution per unit to investors. So as long as they pay out at least 90% of their distributable income, there will be tax benefits. On the other hand, for private core funds, while distribution yield is certainly a factor that they do look into, they also do consider the potential for an asset to appreciate over time, much more so than a REIT would. So for example, let's say there is a mall, brand new, well-designed, great tenant mix, great location next to a MRT station, for example. And the acquisition price that you could buy it at could be materially less than a recent transaction in that area. But the issue is that the rents for the mall and that area are very, very low. So the yield is going to be unattractive for this asset, for a REIT. And as a result, it may not be as suitable for a REIT versus a private fund, where they can probably wait a few years in expectations that the rents will probably grow over time, and that would further lead to further capital growth for that asset. One other thing I'd probably mention on maximizing distribution yields for REITs is that because of this focus on trying to maximize the yields, sometimes their underlying assets may not be performing well, and it might be due to vacancies rising, being unable to achieve higher rents. And so sometimes what you do see is that certain REITs do look to sell some of their non-core assets, and with the proceeds from those asset sales, they then look to pay that out as capital distribution to sort of enhance their distribution. But in the long run, that would not be a sustainable kind of solution. So something to bear in mind when you are investing in REITs. And that's not something that you really see for private core funds, where they are pretty transparent as to what is coming from the income component versus what is being returned to you if they do sell any assets. Yeah, the last thing to really point out really is that last row on pricing versus net asset value. So private real estate funds trade on they basically trade at an independent valuation approach, whereby I guess taking a step back, within real estate, it's common to get buildings valued by independent appraisers. And some of the large groups which conduct these kind of appraisals would be, your CBRE, JLL, and Colliers, for example. And so private core funds always trade based on those valuations by those independent appraisers. REITs, on the other hand, while they do have external appraisers, which value their assets at least 1 to 2 times a year, we don't necessarily see that the share price necessarily matches those valuations done by those independent appraisers. And there's a few reasons why that may be the case. But for example, size premium, for example, what you do see in the REIT market is that you'll find that larger market cap names tend to trade at a premium or a smaller discount to valuations than for the smaller REITs. And one reason for that is for larger market cap names, they tend to be more liquid. And so it's more accessible for institutional investors to enter. Because for smaller REITs, it's just not going to be worthwhile for them to enter into those positions, as they will be able to move the share price dramatically without it really impacting their overall portfolio. And the other, I guess, main reason is for geography as well. There can be a premium for the location. So typically, what you see is in the S-REIT market, the REITs holding Singapore assets tend to trade at premiums or smaller discounts to the valuations than the REITs which hold overseas assets. And the rationale there is that investors are just more familiar with the Singapore or Asia market, whereas an asset in the US or Europe, for example, is a lot less familiar to the investors. And so they require some kind of discount to the valuations as a form of protection, I suppose. So in that respect, if you do want overseas exposure to non-Singapore real estate, I think If you want to get, say, US exposure, for example, there is a lot of benefit in going with private core funds that do have specialist operations that are focused only in the US. As the quality of the assets, I would say, would generally be quite a bit higher than what you would see in the S-REIT market. So I think that's quite a lot to take in. But I guess to summarize on this slide, I would say the key differences between REIT and private core funds are that you obviously have better liquidity for REITs. REITs focus on maximizing their distribution yield, and REIT share prices could trade at a premium or a discount to the independent valuations, whereas private funds trade at those valuations specifically.
Right, thanks, Dan, for the great insight and some of the very important considerations. And of course, performance is important, so we'll be looking at that next. So while both REITs and private real estate funds invest in what is essentially the same underlying asset class, the different structures can lead to very different return profiles. So here we have the US Private Real Estate Index in blue, with the US REIT Index and S-REIT Index represented by red and yellow respectively. So notice that for the majority of the past decade, all three indices have been on a clear upwards trend. And at varying points in time, such as the end of 2019 and 2020, their performance were largely the same. However, if you look closer, you can actually tell that the REIT indices have been a lot more bumpy, with two significant drawdowns in the past 3 years. So the onset of COVID in March 2020 saw a more than 20% decline for both REIT indices, while last year's Fed rapid rate hikes also led to significant declines. So on this table here, we can see that the volatility and drawdowns actually translate into very different risk to return profile for the REIT indices compared to the private real estate index. So the returns for private real estate look a lot stronger, but as we noticed in the previous graph, this can be highly dependent on the time period that we use for comparison. But when looking at the volatility and max drawdown, you can see that it's a lot lower for the private real estate. And so that somewhat represents a smoother investment journey along with a better risk to return profile. So now the natural next question to ask is whether all private real estate strategies are the same. So for this, Gus, could you walk us through the different strategies and styles that you probably would be very familiar by now?
Yeah, for sure. Could we look at the next slide, please? So I guess the way we look at it, we've broken it down here into three different types of risk profile. When we look at real estate, so on the left-hand side, you see there's core, in the middle, there's value-added, and on the right, there's opportunistic. So core being the lowest risk and opportunistic being the highest. So it's just some terminology that we use when we look at real estate investing. So an example for core might be a fully occupied office building in the Singapore CBD. So super safe, relatively low risk. Let's say you have some blue chip tenants that have signed long-term leases in the building, so you know you have a stable stream of income. They pay their rent on time. And the trade-off obviously would be lower total returns given, excuse me, the pricing would be quite expensive for that type of building, and it's most of your returns coming out of income rather than any outsized capital returns. Some other features of core leverage. So when a fund manager would purchase a stabilized building, they might take on less leverage to buy it for their fund. Also diversification. So if you were to buy into a core fund, you would expect that it should be relatively more well diversified. And that's why it's on the lower end of the risk spectrum. Now, on the other hand, you have opportunistic investments, right? So you might have a strategy where you buy, let's say, land parcels in an emerging market like India, for example, and you take the risk of having to apply for government permits, development approvals. You have to build the actual building, right? So you take the risk of building and construction, raw material prices. And then when it's built, you have to find tenants to occupy the building. and then you have to sell it. So you might take on a bit higher leverage in these types of strategies, given there's a focus on larger capital appreciation. So that helps to juice up that portion of the returns. And typically leverage would be a little bit higher. So you take on a lot more layers of risk, but potentially for more outsized returns, given you have a lower cost basis of buying land and raw materials, and then selling the stabilized building at the end. So value add, then it might fall somewhere in between. Maybe something like the case study I mentioned earlier about the Singapore office, where you buy an older style building and fix it up by doing a little bit of refurbishment, spend some money to spruce it up, mix up the tenants, and then you sell it after that.
Yep. Thanks, Gus.
Next slide, please.
Yep. All these strategies certainly sound interesting, and glad to know that there are different styles for different risk appetites. So I would think that I'm actually quite a high risk taker. Am I able to get access to these different strategies via REITs?
Yeah, I guess there's a few ways. You could then get exposure when you start investing into real estate. So I think this slide illustrates broadly 4 different routes you could invest, the various trade-offs or features that differentiate the opportunities, right? So if you start from the left side, we call it going direct, where you might spend, I don't know, 200 to 500 million, and you could afford to buy 1 or 2 warehouses or logistics assets, or maybe just even 1 office building. But there'll be certain trade-offs. The bars at the bottom try to illustrate that. So, you would have exposure to just 1 asset in 1 country. So you take very specific single asset, single country risk. You have lower liquidity in that when you try and exit that position, it's not like you can get your money out immediately. You have to sell the entire building. That takes time, it takes costs, and it takes a lot of time to manage that position. So it could be complex. It's not like someone's going to pay you, valuation for it the next day. On the other end of the spectrum, all the way on the right, you see you could buy listed real estate securities, or let's say REITs. That would give you exposure to hundreds or maybe even thousands of assets. It has the highest liquidity because it's listed. So like Dan said earlier, right, tends to be lower yielding, tends to be more volatile as well, given it's part of the equity markets. In the middle, if you look on the left-hand side, we have single funds where exposures could be a handful of assets or 50 to 100 assets. These funds might have a specific geographical or sector focus. So a fund manager might do, US only, or they might do, let's say, Australian office only. And then when you invest in this type of fund, you'd have more diverse exposure than you would just buying a couple of assets. You might have slightly better liquidity. I think Dan mentioned earlier, you might be able to submit, redemption requests, let's say quarterly or annually, to get your units out of the fund. Or you may also sell your units on the secondary market to other investors. And then lastly, there's multi-manager / fund-to-fund solutions, right? Where you could buy units in the fund-to-fund type vehicle. And this type of vehicle invests into direct real estate funds, so these single funds. It also might take positions in single assets, along with other managers and other JV type structures. So with that type of product, like a multi-manager, you might get a bit better liquidity in terms of being able to submit redemptions, let's say monthly. You might get even more global diversification. If the product is large enough in particular and has the benefit of scale, you also get things like fee savings. Because if you invest into a single fund, they have fee tiers, right? So maybe you put in 10 or 50 million, you're subject to 1 fee tier, but a large scalable multi-manager might be able to put in larger check sizes and have lower fees. And multi-managers may also have exclusive access to opportunities that single investors would not. They'd have relationships with fund managers and other institutions that other people just wouldn't have access to.
Yeah, thanks, guys. It's actually quite interesting that the differences you describe are actually quite similar to an investor choosing a few stocks on its own compared to him buying a broad equity mutual fund, for example, since the trade-offs are also between liquidity, diversification, and cost. So how does having a global real estate exposure actually help my portfolio?
Yeah, thanks. I mean, there's a lot of numbers on this chart, so I don't want to labor too much on it, but I think we aim to show one or two conclusions. So if you look at the bottom right table, this is sort of the historical returns and vols. Vols is in the standard deviation of the return, so how volatile returns are over time. So I think if you're an investor with a focus on the longer term, then this is something worth looking at. What you'll realize is that unlisted real estate funds have a volatility closer to bonds and fixed income, and they end up delivering returns somewhere between bonds and equities. Further, I think unlisted real estate funds show, if you look at the table right above that, right, they show a relatively low correlation with some of the other traditional asset classes. And I think what that means is that, it makes a decent case to be included in a multi-asset or multi-strategy portfolio. That's what the two donuts and table on the left hand of the slide illustrate, that historically over a 15-year period, if you had included unlisted real estate into a portfolio that holds traditional equities and bonds, you'll see your Sharpe ratio returns improve while also lowering the portfolio volatility. And so I guess the lower vols, partially are due to some of the reasons that Dan outlined earlier and how the valuations work. Independent valuers, rather than being subject to fluctuations in global listed or equity markets. Next slide, please. So I think this slide tells a similar story broken down now about the benefits of diversification, and rather the benefits of going global, and having a global allocation rather than just focusing, let's say, on one single country or single market. So in this correlation matrix, you can see that unlisted real estate markets across key markets, there's APAC, Europe, and the US, they're maybe not as correlated as you might have thought. And I think over time that truly plays out. Real estate fundamentals tend to be different in the markets. The macroeconomics of each country or region are not always in sync one-to-one. If you take COVID, for example, right, it's a global phenomenon that you might think all real estate markets would have reacted the same, just like how the equity markets would have tanked. But that hasn't exactly been the case. So some markets, as we know, had a much faster rebound or recovery from COVID. Excuse me. China maybe was the one that stands out as a bit of a laggard globally. Some types of real estate would have performed better than others over the pandemic. So, logistics, for example, everyone was stuck at home. Everyone's buying things online. So companies that make a business out of delivering goods to end users are now scrambling to get more and more warehouse space that they need to store. And so they're willing to pay higher and higher rents. So, warehouse logistics had done well versus, let's say, retail, for example, that would have really suffered because people just aren't visiting shops physically over the pandemic, right? Circuit breaker and lockdowns, and hotels suffered as well. So I think that tells a good diversification story and makes a good case at least to consider going global and to get diversification across different types of real estate sectors and subsectors, but also across the different countries even.
Yeah, that's great, guys. Thanks for that. I would also like to add that private real estate has historically displayed an ability to hedge against inflation. So on the left graph, we can see that in the two scenarios where inflation has been high, private real estate tends to do very well with returns of more than 15%. But if we further break down the returns as seen on the graph in the right, you can see that even though US equities still gave a nominal return of about 4.2%, if you strip away the effects of inflation, US equities actually provided a negative 1.7% real returns. However, Comparing that to private real estate, you can see that even in periods of high inflation, the real return continues to be positive at about 5%. So the key attractiveness that Gus and I described earlier are of course recognized by institutional investors as well. And so this is why we can see that institutions' allocation to real estate has been quite high and continues to grow over time. And again, Endowus' mission is to bring institutional products to our investors. And this will be no different in the case of real estate. Right, and to round things up, Dan, in your role as an associate portfolio manager, could you provide us with some insights as to the considerations when investing in private real estate?
Yeah, sure. So in terms of the benefits, that first row of adding real estate to your portfolio, I think Gus has already talked about that quite extensively. But I think to summarize, adding global real estate due to the lower correlation to other asset classes does provide diversification and can improve your risk-adjusted returns. So most of the presentation so far has really been about the benefits of investing in private real estate, but of course there are risks to any investments, which we should also flag. Firstly, with any sort of global exposure, there is going to be currency risk that you do take. And as we've seen in the past few years, that can have a material impact to your returns. Of course, there are ways to mitigate that through FX hedging, but something to be aware of. Secondly, on the tax, this can actually be pretty punitive depending on the country that you are in, and can definitely impact your underlying returns. In the US, for example, income and capital gains tax can be around 30 to 21%, 30% and 21% respectively. But in some cases, that can be less if you invest into a core real estate fund where you are exiting units in the fund rather than selling the assets to a new buyer. And then lastly, on the transparency of information, that can definitely vary quite a bit from market to market. So for Singapore, as an example, it's definitely a very transparent market, as I think most of you are aware. Information is definitely readily available. Australia is also a pretty transparent market, but conversely, markets like Japan, which may be surprising for some of you to know, is that it actually is not necessarily very transparent. You can probably find information about assets being sold, but if you want to know more about the specifics on the assets and the pricing, it can be actually very difficult. So that lack of transparency, however, can also create opportunities. So by partnering with groups that have strong on-the-ground teams, it definitely has advantages of having a little bit more of an edge versus some other players that may not have people on the ground in those markets, for example. So I think, yeah, those are the key points on that slide. If you could go to the next slide. Again, yeah, quite a lot listed here, but I think, yeah, a few of them have already been touched on. There's really two things in particular which I wanted to discuss here relating to point 1 and point 4. For point 1, I think it's important to consider what your investment horizon is and your liquidity requirements, as these will impact your income and capital return targets. Typically for core investments, they are lower returning, and as a result, you're going to see probably a roughly equal split of income and capital return. But as you take on more risk, as Gus talked about earlier, when you do value add and opportunistic investments, your returns are going to be primarily driven by your capital return component. And so these capital return components, when you're doing refurbs and constructing new buildings, they take several years to complete. So you do have to have a longer horizon to take on that kind of risk for it to make sense for you. And lastly, on that point 4, I really just really wanted to focus on that last dot point there, which is on the deployment schedule. Particularly when you're investing in closed-ended funds, which are more value-add and opportunistic in nature. Because these funds do take a number of years to get drawn, typically 2 to 3 years for your capital to be fully drawn that you commit. I think it's important to think about how you manage that undrawn capital, whether it be in short-term liquid investments. I guess with interest rates rising now, that that opportunity cost is more attractive to be able to have something that you can put in short-term deposits. But in the past, that was, I think, a bigger consideration as to what you do with that undrawn capital.
Yeah, that's great, Dan. Hope that was very helpful to our audience. So I think that brings us to the end of the presentation. So we will move on to Q&A. So I do see some interesting questions on Slido. So the first one would be, so analysts are downbeat about commercial real estate. How bad actually is the situation for commercial real estate?
Okay, maybe I can kick it off, Gus. So yeah, firstly, I'd say that for office in particular, the whole situation is definitely evolving still. So I wouldn't say there's been a clear conclusion necessarily for office globally, but definitely what we're seeing is that in the US, office is definitely taking a very big hit right now. And that is definitely a key concern for a lot of real estate investors. I would say generally we're starting to see some correction in other parts of the regions, including Asia. But the general thinking has been that, in markets like Singapore, or Japan, for example, typically the household sizes are smaller. The ability to work from home is not so conducive as some of these other markets where they do have a lot larger homes and can have their own office space to take video calls. So that does, I guess, limit the ability for some people to be able to work from home in a conducive environment.
Yeah, I think it depends a little bit on what market and what sector you're talking about. I think there is a little bit of a divergence, right? So Dan's mentioned office just sort of globally. We're a little bit more cautious on, I think rightly so, given changing trends like work from home. I think some markets like the US and the UK valuations have tended to be written up pretty quickly, and in today's climate, written down a little bit quicker relative to APAC. So I think APAC valuations we've seen haven't written up as strongly over COVID, and they're a little bit less volatile. I think there's also pockets of still positive opportunities. For example, residential for rent, I think globally is a pretty strong theme. When you invest in residential for rent type properties, what you get is leases that tend to be quite a bit shorter. So, for example, in office or in warehouses, the tenants would have signed up for lease contracts for anywhere between, let's say, 3 to 5 to 8 years, and that they've signed up to the rent growing anywhere from, let's say 2 to 3% per year. And right now, that's just not enough to beat inflation, right? Residential for rent leases tend to be a little bit shorter, anywhere from 6 to 12 months. So what that means is that if you are the owner of that type of property, you're able to mark your rents at a higher rate just to keep pace with, growing inflation needs, and that helps your income at least a little bit. So I think generally, weakness and cautiousness over some sectors, yes, but I think there's some good pockets of opportunity still to be had.
Right, thank you both. The next question is also, it's about given the economic and rates uncertainty at this point in time, how should investors actually weigh the illiquidity risk that comes from investing in private real estate?
Yeah.
Yep.
I'd say that, when you look at, sorry, Gosh. Yeah. I'd say when you're looking at, say, REITs and private real estate, with any portfolio, you probably want to diversify and have both, because I think, as we shown earlier, there is definitely benefits to your risk-adjusted return from having both, not just one or the other. So that's, I think, one key consideration. But generally, I would say that globally right now, REITs are generally trading at a discount to their NAV, or the valuations by independent appraisers, which I talked about earlier, more so than historical. So in that respect, you could potentially argue that REITs are I guess, a bit cheaper at this point in time than private real estate. But again, that's kind of a broad kind of statement, I suppose.
Yeah, and I guess it's also important to know that real estate or unlisted real estate as an asset class in general is considered an illiquid, right? I mean, we were talking earlier about, maybe through this type of product, you get a little bit more liquidity, as in you could submit a redemption more frequently compared to let's say a single fund. But I think in general, the principle is that it is an illiquid asset class, and that's something to remember. So it's not exactly something that you want to be trading in and out of, maybe like your equity portfolio, right? It's something that over the long term provides good risk-adjusted returns, low vols. So I think the argument to be made to have it in your portfolio is to have that as sort of a nice little sticky part of your portfolio rather than looking to, sort of trade in and trade out and pick bottoms.
Okay, great. There's also a question about the choosing of the time period, so I can take that. So the reason why we use quarterly returns is because for the private real estate index, the returns tend to be reported on a quarterly basis. Hence, there's no kind of like monthly returns for max monthly drawdown. And the reason why we started from 2014 was actually this is when the S-REIT index actually came about. So we can certainly extrapolate the investment time horizon, but I would say the risk return profiles would still look very similar for both public REITs and private real estate. Yep, and there's another good question. So if you could provide your unbiased opinion, which is what is a good percentage of my portfolio that should be in real estate?
That might be one for you guys, Yuhang. I mean, you guys manage sort of multi-asset portfolios. I mean, if you ask me, I'd say as much as you can.
Well, we do like to say always invest in things in moderation. So yeah, speak to your nearest friendly kind of advisor for more information. There is a question about factors to consider before deciding if one should invest in REITs and private real estate funds. I think we covered that broadly. So it's around, of course, liquidity, tax, and other factors. Okay, next question is, in today's economic climate, is there an optimal tenant mix to avoid sector or market concentration? So for example, overexposure to tech companies that we've seen had experienced a bit of negative news recently.
Yeah, that's a good question. I mean, you'd probably want to avoid any sector that looks very tightly priced, as in that's had a really big run up over COVID, now looks expensive and is under threat to lose some valuation now that rates have begun rising. So I guess we alluded to it a little bit earlier. Sectors like U.S. industrial look a bit tightly priced, Australia industrial, because logistics, obviously, warehouse has had big run up, right? Office, generally, we're pretty cautious. It tends to not do well in these types of cycles. What else? And I think residential outlook looks pretty positive. I think alternative sectors become interesting. Alternative sectors that are on the rise in terms of institutional interest as well. I think things like student accommodation, for example. I think if you look at globalization now and how people are able to freely move out of their country, study overseas, accommodation requirements for students, there's an undersupply, right, for that type of asset. First, second-year students travel out of country to a new country. It's not easy to find accommodation. So if you have sort of assets that are purpose-built near campus, good security offerings, that's something attractive for students. I think that type. Alternative living type sectors, I think, can be pretty interesting if you talk about thematics like aging population and elderly care. So sort of residential communities that are built with some element of support or medical support for the elderly, I think are interesting. Data centers that Dan alluded to are interesting. I don't know, Dan, what else do you think?
I mean, I guess broadly speaking, I'd say there's a right price for everything. So regardless of the sector, there's probably, if you can get in at the right price, then you can still get attractive risk adjusted returns. So I would say we also are quite cognizant of looking at bottom-up opportunities in this sort of environment. So being quite specific about certain sub-markets where we see opportunities that could outperform others, for example. I'd say more bottom-up at this point in time is probably a key focus for most real estate groups.
And tenant mix, I mean, in terms of the types of tenants, I mean, I guess you're going to want to always look for good quality tenants. I think, like you said, tech tenants. Yeah, I mean, there's a little bit of volatility in that sector now, right? And layoffs and news of tech companies just taking less space. So, obviously there's caution around that. I think in the last 2 or 3 years, some tech companies would have taken a lot of office space, and there's news of sort of downsizing now. So obviously that's a threat, right? I think co-working at one point was really hot, and now some of that space you want to be a little bit cautious of as well. But yeah, I think that's a good point.
Okay, great. And so the next question is actually perfect for both of your expertise. So how will you actually evaluate which private funds to invest in, as the information tends not to be readily available and pricing is also at NAV as mentioned previously?
Yep. It's a good question. I mean, I think it depends on how diverse you want to go and what type of strategy you want. So, whether you're looking at US only, APAC only, there's a lot of options. I think what is important is, having someone with the expertise to be able to, dissect the detail of a manager's track record. You want to ensure that they have a proven track record, being able to execute the strategy that they're proposing. Ideally, you're not just throwing them money in a blind pool set and just having them do whatever they want. Ideally, they have some assets or case studies they can show that clearly displays that expertise. What else? And I think diversification, right? So I guess if you're looking for the long term, if you're less, a bit more risk averse, multi-manager solution could be interesting for you because you're investing with a manager then that has expertise to on the ground experience and has relationships with all key managers around the globe that are able to pick, I guess, best in class strategies and partner with some of the best managers. And they also get to see deal flow that you just wouldn't be able to see as an individual looking around for yourself.
Yeah, so maybe just to add a little bit, I think when you're picking private real estate funds, definitely things like the team, their track record, how long the team has been together for, in terms of their strategy, how sustainable, how replicatable is it going forward in the current environments, how transparent and open they are with information is usually a big one as well. And then, for open-ended funds, usually there's an existing portfolio that's already there, so we can, have a view on whether those assets are attractive and their outlook. For closed-ended funds, usually they tend to be more blind pool in nature, whereby there aren't any assets in those funds. But again, that comes down to the track record and understanding the team and their history and their ability to replicate that again. So I think broadly with real estate, scale is very important. And as Gus mentioned before, groups such as UBS, for example, we do see quite a lot of opportunities, and having more opportunities allows us to pick the best ones to try to get best returns.
Okay, thank you. We are running out of time, so we'll end with this last question. It's actually quite topical. So views on data centers, and I think I read recently that this is one thing that Malaysia is actually also targeting. So could we have your views on the data centers, please?
Okay, yeah, sure. So data centers, yeah, it's definitely an area which we've been actively looking to get more exposure to. I would say over the past, call it 3 years or so, we've been making more of a keen. We've had more of a keen focus on data centers and been following the space a lot more closely. I think going forward, the thematics are still very strong, and there is very strong demand that will continue. But I guess, with any kind of thematic, there are things to be aware of, especially with data centers. It's really being dominated by hyperscalers. So when I say hyperscalers, it's groups that take up a lot of capacity. So your Amazon, your Google, your Microsoft, for example, they are the key players in this market. And because they're so big, the risk is that they are able to kind of control the rents a bit by being so dominant. So while it is a very attractive sector thematically, just have to make sure that the returns also stack up and making sure that you can get the right kind of rents.
Okay, guys, if there's nothing to add from your side, I think we can conclude the presentation. Thank you so much for the audience for spending an hour with us. If you have any questions, please feel free to drop us an email as well. So with that, I will conclude the webinar. Thank you, everyone.